Okay, let's go ahead and get started. I would like to welcome the students back for our second lecture today, as well as our faculty. I know we have some new guests and friends that are here today. You are in for a treat. If it's anything like it was Tuesday, this will be another great session. Without further ado, Chairman Bernanke.
Thank you very much. You came back. That's good news. As you know, today is the second of 4 lectures on the financial crisis in the Federal Reserve. As I said, I think it's very helpful to try to put the recent crisis and the ongoing recovery into an historical context. And so last time we talked about the origins of central banking, going back to Bank of England and the debates of the 19th century, the origins of the Federal Reserve, and the Federal Reserve's first great challenge, which was the Great Depression of the 1930s. And we drew some lessons from the 1930s that will come back and be relevant as we discuss more recent events. Today, I'm going to pick up the history after World War II, talking about some important episodes after the war. But I will be getting in today to the beginnings of the crisis. And so the latter part of today's lecture and all of next week will be about the crisis. Now, as we go along, I just want to make sure you keep your eye on the ball. Thematically speaking, the 2 basic ideas, the 2 basic missions of a central bank are first, macroeconomic stability, maintaining stable growth and keeping inflation low and stable. And of course, as you know, the principal policy tool for maintaining macroeconomic stability is monetary policy. In normal times, the Fed or other central banks will use open market operations, purchases and sales of securities in markets to move interest rates up or down, and in doing so, try to create a more stable macroeconomic environment. So that's an important part of any central bank's mission. The other part of its mission, though, is financial stability. Central banks are focused on trying to ensure that the financial system is functioning properly, and in particular, they want to prevent, if possible, and if not, to mitigate the effects of a financial crisis or a financial panic. And we talked last time about the lender of last resort function, the notion that in a financial panic, a central bank can follow Bagehot's rule of lending freely against good collateral at a penalty rate, and that by providing short-term credit to financial institutions, a central bank can offset the effects of a run or a panic and the accompanying damage to the financial system and the economy. But let's move ahead and talk a little bit about the history. We left off at World War II, which ended the Depression, which led to a sharp drop in unemployment as people were put to work building munitions and serving the home front. Now, one of the aspects of wars that economists pay attention to is how wars get financed. And normally, wars are financed very substantially by borrowing. And this was not a surprise. U.S. national debt was built up quite substantially during World War II to pay for the war. And the Fed, in cooperation with the Treasury, used its ability to manage interest rates to keep interest rates low so as to make it cheaper for the government to finance World War II. So that was the role of the Fed during the war. Now, after the war ended, the debt was still there. The government was still worried about paying the interest on the national debt, which was at a very high level. And so there was considerable pressure on the Fed to keep interest rates low, even after the war. But there was a drawback to that, which is that if you keep interest rates low, even as an economy is growing and recovering, you're risking an overheating economy, you're risking inflation. So by 1951, the Fed was very concerned about inflation prospects in the United States. And after a series of complex negotiations, the Treasury agreed to end the arrangement and let the Fed set interest rates independently as needed to achieve economic stability. And that agreement was called the Fed-Treasury Accord of 1951. And it was very important because it was the first clear acknowledgement by the government that the Federal Reserve should be allowed to operate on an independent basis. And today, around the world, there's a very strong consensus that central banks that operate independently will deliver better results than those which are dominated by the government. In particular, a central bank which is independent can ignore short-term political pressures, for example, to pump up the economy before an election. And in doing so, it can take a much longer perspective and get better results. And the evidence for this is quite strong. And as a result, major central banks around the world are typically independent, which means that they make their decisions irrespective of short-term political pressures. Now, in the 1950s and the 1960s, the primary concern of the Fed was macroeconomic stability. You see a picture there of the chairman, William McChesney Martin. He was chairman from 1951 to 1970, 19 years. He was the leader of the Fed. Chairman Greenspan's term ended at 18 years, 6 months. He unfortunately didn't break the record. I know he was very disappointed about that. But in that case, we had two Federal Reserve chairmen who between them accounted for more than 37 years of leadership at the Fed during the post-war period. Now, monetary policy during the 50s and early 60s was relatively simple. The economy was growing. Again, as after World War I, after World War II, the U.S. economy was dominant. The fears about a renewed depression had not come true. And as a result, a lot of growth was occurring. What the Fed tried to do basically was follow what's called a lean against the wind monetary policy, which means that when the economy is growing quickly, or perhaps too quickly, the Fed tightens to try to restrain overheating. And when the economy is growing more slowly, the Fed lowers interest rates, creates some expansionary stimulus in order to avoid a recession. William McChesney Martin was very attentive to the risks of inflation. He's having a quote there from him, "Inflation is a thief in the night." And he tried, through this lean against the wind policy, to keep inflation and growth stable. And indeed, despite the fact that the 50s were perhaps more tumultuous than you might think, there was, after all, a serious war in Korea. There were a couple of recessions during that decade. Nevertheless, it was basically a productive and prosperous decade as the economy went back to civilian operations after the end of World War II. However, as usual, things were not to remain completely trouble-free. Starting in the mid-1960s, for a variety of reasons which I'll talk about, monetary policy became too easy. And after a period of time, and given the Fed didn't change its policy stance, this easy monetary policy led to a surge in inflation and inflation expectations. And on the right, you see a graph of inflation. You can see from 1960 to 64, inflation averaged only a little over 1% a year. It picked up during the Vietnam period, 65 to 69, even higher in the early 70s. But by the end of the 70s, the CPI inflation rate peaked at about 13%. So you can see inflation was a growing problem starting in the mid-60s and into the 70s. So an important question is, why was monetary policy so easy as to allow inflation to become a problem in the 70s? Well, one issue was really a technical issue, which was that monetary policymakers became too optimistic about how hot the economy could run without generating inflation pressures. There was a general view that unemployment could be kept at the low level, like 3 or 4%, and by keeping inflation a little bit higher, you would be able to get that better performance, that higher employment level. And again, in the prosperity of the 50s and the early 60s, the Fed began to follow that approach. There was actually quite a subtle issue here, which was that economic theory and practice in the 50s and early 60s suggested that there was a permanent trade-off between inflation and employment, the notion being that if we could just keep inflation a little bit above normal, that we could get permanent increases in employment, permanent reductions in unemployment. And that was the view that was taken by many economists during that time. It was actually Milton Friedman, the famous monetary economist, who wrote in the mid-60s, quite prophetically, that this was going to cause trouble. And he argued that increase in inflation may give you a little bit of a bump up in employment, might cause unemployment to fall for a while, but at best that's going to be a transitory effect. The analogy might be to a candy bar. If you take a candy bar in the short run, it gives you a little bit of a burst of energy, but after a while it just makes you fat. So monetary policy was analogous to that. And Friedman argued, and he turned out to be quite prescient, that attempts to keep unemployment too low through monetary policy were going to end up creating inflation. So that doctrinal issue was one reason why monetary policy was too easy. There are also debates still today about whether or not there were political pressures put on the Fed. After all, this was a period of, again, of government deficits as the government was trying to deal with Vietnam, was trying to deal with the Great Society. And that may have also influenced the Fed's behavior. Now, the Fed, obviously, you can't have sustained inflation without monetary policy being too easy. Another famous quote from Milton Friedman is that inflation is always and everywhere a monetary phenomenon. Nevertheless, there were a bunch of exacerbating factors that made the problem worse and made it more difficult for the Fed to offset the increase in inflation. First, there were a number of shocks to the prices of oil and food. A very striking example was in 1973. In October of 1973, the Yom Kippur War in the Middle East broke out. In retaliation to U.S. support of Israel, the OPEC, the Organization of Petroleum Exporting Countries, found some cartel power, put an embargo on oil exports, and in a short period of time, in the early 1970s, the price of oil almost quadrupled. So a very sharp increase in oil prices and thus in gas prices. People were lining up at gas stations to make sure their gas tanks were full. There was a system of even-odd rationing. If your license plate was even, you could only go on Tuesdays and Thursdays to the gas station. If it was odd, you could go on Mondays and Wednesdays. So it was a very serious issue, and there's a lot of unhappiness, obviously, about gas prices then, as there is, of course, today as well. Fiscal policy, I also mentioned. Fiscal policy was overall too loose during the late 60s and early 70s. The Vietnam War and other government programs increased government spending and increased deficits, which put additional pressure on the capacity of the economy. Now, another element that I just mentioned briefly is wage price controls. When inflation got up to about 5% in the early 70s, President Nixon introduced wage price controls, that is a series of laws which forbade firms from raising their prices. There were exceptions, and there were boards that tried to find exceptions, and it was basically a very unsuccessful policy. On the one hand, as you know, prices are the thermostat of an economy. They are the mechanism by which an economy functions. So putting controls on wages and prices meant that there were shortages and all kinds of other problems throughout the economy. But in addition, again, as Milton Friedman put it, this was like dealing with a overheating furnace by breaking the thermostat. I mean, the fundamental problem was the fact that there was too much aggregate demand driving up prices, and simply passing a law which says people couldn't raise prices doesn't address the underlying problem of excessive monetary ease and excessive demand. So the wage price controls kept inflation artificially low for a couple of years, made it harder for the Fed to figure out what was going on. And when the wage price controls finally collapsed in disarray because they were creating so many problems in the economy, inflation surged as like a spring that was released at the end of the wage price controls. So there were a lot of reasons supporting the increase in inflation. I think a general lesson, here's a picture of Arthur Burns, who was the chairman of the Fed during the 1970s. And the quote is, in a rapidly changing world, the opportunities for making mistakes are legion, which is certainly true. I think one way to think about this whole episode is that after World War II and the end and the conquest of the Depression and the prosperity that they saw, economists and policymakers became a little bit too confident about their ability to keep the economy on an even keel. And there was the term fine-tuning, the notion that the Fed and other fiscal policy and other government policies could keep the economy more or less perfectly on course and not worry about bumps and wiggles in the economy. Now, that turned out to be too optimistic, too hubristic, and we learned that collectively during the 70s when the efforts of policymakers resulted not in the lower unemployment rate, which was the original goal, but instead a higher and very sharp increase in inflation. So I think one of the themes here is that, and this probably applies in any complex endeavor, that a little humility never hurts. Now, there was a reaction to the increase in inflation in the 70s, and the key person in this period is Chairman Paul Volcker, who remains to this day an influential figure in economic policy discussions. To deal with double-digit inflation, I should say first that President Carter, whose re-election was under serious threat by the poor performance of the U.S. economy, appointed Paul Volcker to be the new chairman of the Fed. And in part he did so because President Carter thought that Volcker was a tough central banker who would do what was necessary to get inflation under control. And Paul Volcker, who stands 6'8" and smokes a big cigar, was certainly created a impression of somebody who's willing to take strong action. And perhaps it wasn't a total coincidence. So Paul Volcker came into office. He was only in office for a few months when he determined that strong action was needed to address the inflation problem. And in October of '79, he and the Federal Open Market Committee, the policy-making committee of the Fed, instituted a strong break in the way that monetary policy was managed. It's not really necessary to go into the details of what that break was and how it worked. Basically, what it did was allow the Fed to raise interest rates quite sharply. And again, as you know, raising interest rates slows the economy and brings inflation pressures down. As Paul Volcker said, to break the inflation cycle, we must have credible and disciplined monetary policy. And it worked. In the years after this program began, inflation fell quite sharply. You can see from 1980 to 1983, inflation fell from about 12 or 13% all the way down to about 3%. So a relatively quick decline in inflation that offset the problems of the late 70s. So in that respect, the policies of the 80s were quite successful. They achieved their objective of bringing inflation under control. However, nothing is free, and one of the effects of these policies was to raise interest rates quite sharply. I do remember vaguely I just got out of graduate school about 81, 82, and I do remember looking at the possibility of buying a home and being informed that the mortgage rate for a 30-year mortgage was 18.5%. So interest rates were quite high, and as you might expect, that brought down economic activity and affected inflation as well. So if you look at the graph, you see this is the unemployment rate. The high interest rates, which were necessary to bring down inflation, also caused a very sharp recession. And in fact, the unemployment rate in 1982 was almost 11%, even higher than we saw in the most recent recession. So there was definitely a very negative side effect from Volcker's activities. Now, I think an interesting aspect of this is that the political pressures you can imagine on the Fed and on Chairman Volcker was intense. During this period, it was a common practice to mail to the Fed bits of 2x4s. And on the 2x4s it would say, "Stop killing construction," or "Save the farmer," or whatever it might be, because the high interest rates were having very negative effects on the economy. And I have a few of these on my desk just to remind me, that inflation is a concern and that we always have to pay attention to price stability. But this is also an example of why independence is important. If Paul Volcker had been to be reelected, perhaps he wouldn't have been able to sustain this policy. But instead, he maintained an independent monetary policy. He received at least sufficient support from President Reagan and from the Congress. And he was able to carry through the policy, which, again, succeeded in bringing inflation down. Now, during the 70s, obviously, output and inflation were very volatile. We saw how much inflation moved around. We saw that there was, I didn't mention, but there was a pretty sharp recession also in 1973 to 75 after the OPEC embargo. And then, of course, there was more volatility in the early 80s as Volcker brought down inflation and as the economy went into recession. Now, Paul Volcker left the chairmanship in 1987, and he was replaced by Alan Greenspan, who, again, held the position for almost 19 years, from 87. As the quote suggests, one of the important accomplishments of Greenspan through most of his tenure was achieving greater economic stability. As he says, greater economic stability has been key to impressive growth in standards of living in the United States. So, in fact, there was so much improvement in the stability of the economy that the period has come to be known as the Great Moderation, as opposed to the Great Stagflation of the 70s or the Great Depression of the 30s. Now, this was a very real and striking phenomenon, the Great Moderation. The first picture here shows you the variability of real GDP growth. So the graph covers the period from 1950 all the way up essentially to the present. The line just shows you quarterly growth rates in GDP. So a sharp line, a sharp peak shows an increase in GDP growth. A negative decline shows a fall in GDP growth. These are quarterly numbers. And so you can see the bounciness, periods of growth followed by periods of slower growth. The yellow bar is a one standard deviation band. Essentially, it's a measure of the average volatility of GDP growth quarter to quarter during the period between 1950 and 1986, or 85, I guess. And you can see that GDP growth was pretty variable throughout the entire period. There's a lot of volatility in the economy. There were a number of recessions, including the severe ones in 73 and 81. Now, amazingly, starting from about 1986, look at what happens to GDP variability between 1986 and 2007 or so. The variability from quarter to quarter is much less. And the blue line shows the average variability, a one standard deviation band, for GDP growth in this latter period. And it's just very striking how much more stable the economy was over this 20 or so year period. This was true not only for real GDP growth, it was also true for inflation. So again, it's the same picture basically. The vertical line in the middle of the graph splits the time period from pre-1986 and post-1986. The graph shows inflation quarter by quarter as measured by the Consumer Price Index. Again, the tan bar shows one standard deviation average volatility of inflation in the pre-1986 period. You can see the huge spikes in inflation in the 70s. And then in post-86, you see much more stable, much lower volatility. So both growth and inflation were much more stable, and are really quite remarkable to a quite remarkable extent, and something that economists commented on quite frequently. So that was so-called Great Moderation. Now, why? Why was the economy so much more stable between the mid-'80s and the mid-2000s? Well, there's lots of research on it, a lot of issues, a lot of papers. I think there's a good bit of evidence that monetary policy played a role in creating better stability. In particular, Volcker's contribution was, even though his short-term efforts to bring down inflation in the early 80s led to a high recession, led to a lot of pain, there was a payoff, and that payoff was an economy which was much more stable, with low, stable inflation, more stable monetary policy, more confidence on the part of business people and households, and that contributed very importantly to broader stability. So you remember that the Friedman pointed out that there was no long-term trade-off between inflation and unemployment. By keeping inflation a little higher, you couldn't permanently lower unemployment. But in a different sense, which is true, but in a different sense, low and stable inflation over a long period of time does make an economy more stable and supports healthy growth in productivity and economic activity. So low inflation is obviously a very good thing to have, and the reduction in inflation that occurred in the 80s was really a global phenomenon. A lot of countries had inflation problems in the 80s, but all around the world, even developing countries brought down their inflation rates quite considerably, and that has been a positive for economic growth and stability since the mid-'80s. Now, not all of the Great Moderation was caused by monetary policy. There are other factors, no doubt, playing a role. I mentioned just general structural change in the economy. An example would be that over time, firms have learned how to manage their inventories much more effectively. The practice of so-called just-in-time inventory management is a practice whereby instead of having large stocks of inventories on hand, firms only acquire inputs when they need them to produce. And without large stocks of inventories in hand, that reduces an important source of fluctuations in the economy, because if demand slows down and you have a big inventory, then you don't do any more production for quite a while until you run down that inventory. But improved management of inventories is just an example, and many others could be cited, of better business practices and other factors in the economy that made things more stable. And it may also just be the case that there was better luck, that we had fewer oil price shocks and other things happening, and that too may have contributed to the Great Moderation. But as those previous pictures showed, I hope it's clear that it was quite a striking change in the way the economy operated after the mid-'80s. Okay, now this takes us up then into the mid-2000s, and so now finally we can begin to talk about financial stress and recent developments. Now, just a final word about the Great Moderation. One of the other aspects of that period is that there weren't any big damaging financial crises in the United States. There was a stock market crash in 1987, but it didn't do much damage. A more significant event was the boom and bust in the dot-com stocks in the late 90s, and that touched off a mild recession in 2001. But one of the inferences that people took away from the Great Moderation was not only was the economy more stable, but the financial system seemed more stable as well. And as a result, financial stability policies got de-emphasized to some extent during this period. Well, let's turn now finally to the prelude to the financial crisis. And what I'll do today is just talk about some of the initiating, triggering events, particularly the housing bubble. And again, as I said, we'll get next week into more details about what happened during the crisis and the Federal Reserve's response. One of the key events that led ultimately to the recent crisis was a big increase in house prices. So the graph on the right shows prices of existing single-family homes where January 2000 is indexed to be 100. From the late 1990s until early 2006, house prices across the country increased by about 130%. You can see that line going straight up, a very sharp increase in home prices. And as I'll discuss, at the same time that was happening, or perhaps a little bit later in the process, the lending standards for new mortgages to buy homes were deteriorating. Now, clearly, a big part of what was happening to create the housing bubble or the increase in housing prices was psychology. After all, the late 90s was a period, as you know, again, of a lot of optimism about tech stocks and stock market more generally. And some of that optimism, some of that psychology, no doubt, fed over into the housing market. So there was an increasing sense that house prices would keep rising and that housing was a can't-lose investment. I lived in California for a while, and earlier than this, but it was a period during which house prices were rising, and all everybody ever talked about at cocktail parties was, what's your house price now, and how much money are you making on your home, and it kind of made working kind of unnecessary because all you had to do was keep checking the real estate listings. So there was a lot of excitement and enthusiasm about the fact that house prices were going up and making everybody rich. At the same time that this was happening, the standards for underwriting new mortgages were getting worse and worse, which in turn was bringing more and more people into the housing market and pushing up prices even further. So let's talk a bit about mortgage quality and what happened. Prior to the early 2000s, home buyers were typically asked to make a significant down payment, 10%, 15%, maybe 20% of the home price. And of course, they had to document their finances, their income, their assets, and so on in great detail to persuade the bank to make them a loan, which in many cases might be 4 or 5 times their annual salary. Unfortunately, as house prices rose, many lenders began to offer mortgages to less qualified borrowers, so-called non-prime mortgages. And these mortgages often required little or no down payment and little or no documentation. Now, I say non-prime instead of subprime. Subprime mortgages were the lowest quality mortgages in terms of the credit of the borrowers. But there were other mortgages that were below so-called prime mortgages, so-called Alt-A and other types of mortgages that were also not up to the traditional standards of credit underwriting. So I say non-prime. What was happening again was that essentially that mortgage lenders were moving further down the credit spectrum, lending to more and more people whose credit was less stellar. You can see this in a number of different ways. On the left side of this picture is the percentage of mortgage originations, that is, new mortgages created that were non-prime, that is, either subprime or Alt-A or some other lower quality mortgage. And you can see the very sharp increase, particularly in the middle of the 2000s. In 2006, almost a third of all mortgages that were originated were non-prime. Another indicator of the deterioration of mortgage quality in the right figure is the percent of non-prime loans with low or no documentation. Now, if you think about this, this is kind of perverse. If you're going to make a loan to somebody whose credit is shaky, who doesn't have a down payment, and maybe their FICO score is low and so on, you think you would want to ask them even more questions about their income and their prospects. But in fact, it went the other way, and you can see that by 2007, 60% of non-prime loans had little or no documentation to describe the creditworthiness of the borrower. So there was clearly an ongoing deterioration of mortgage quality. Now, this situation couldn't go on forever. This picture shows the this picture shows the debt service ratio. As house prices went up and up and up, the amount of income or the share of income being spent on your monthly mortgage payment went up. And as you can see, eventually the mortgage payments became quite a large share of personal disposable income, finally reaching the point that the cost of home ownership was high enough that it began finally to dampen the demand for new houses. And as we see, that mortgage debt service ratio collapsed going after that, basically because interest rates came down. But the main point here is that high interest rates, payments on mortgages finally meant that there were no longer new borrowers, new home purchasers, and so house prices burst. The bubble burst. Here's a picture of home prices. You can see again the sharp increase from the late 90s up until about 2006. But from 2006 until today, house prices have fallen more than 30%. So there's been a very sharp decline in home prices across the country. Now, one comment about this picture. If you look at this picture, you might say to yourself, oh my gosh, we have a long way to go. Because as you can see, house prices today are still a good bit above where they were 15 years ago. But remember, these prices are in dollar or nominal terms. There's no adjustment for inflation. So even if there was just 2% inflation a year, over a period of 15 years, that would raise prices by 30 or 40%. So if you adjust this for inflation, you get that house prices now are coming much closer to where they were before the beginning of the bubble. Now, the house price collapse had some significant consequences. One consequence is that many people who had felt rich because their home values had gone up and they had a lot of equity, suddenly they found themselves underwater, which means that their mortgage, the amount of money they owed, was greater than the value of their home. So this is a negative equity. So this is an upside-down situation where the borrower is, in fact, has negative wealth or negative equity in the home. And you can see that starting in 2007, the number of mortgages that were in negative equity grew very sharply. Currently, there are about 12 or 13 million mortgages out of a total of about 55 million or so in the United States. So roughly 20 to 25% of all mortgages are now currently underwater. So that's a very big change from the situation we saw before. At the same time, given the decline in house prices, given the fact that a lot of people borrowed more than they could afford, the decline in house prices also led to a big increase in mortgage delinquencies, people not paying on time, and ultimately the bank taking over the property, and that's called a foreclosure, and then reselling the property to somebody else. So this is mortgage delinquencies. And you can see that in 2009, there were more than 5 million mortgages in delinquency, which is about, again, almost 10% of all mortgages. So a very, very high rate of delinquencies. Now, of course, what we just looked at was the effects of the house price bust on the borrowers and on the homeowners, and those are quite serious. But of course, there's another side to this, which is the lenders, the people who made the loans. And obviously, with something close to 10% of mortgages in delinquency, banks and other holders of mortgage-related securities suffered sizable losses, and that proved to be an important trigger of the crisis. Now, there's an interesting question here. In 99, 2000, 2001, we had a big increase in stock prices, including but not only dot-com or tech bubble prices, and those prices fell very sharply in 2000, 2001, and a lot of paper wealth was destroyed by that. And in fact, the amount of paper wealth destroyed by the decline in dot-com and other stock prices was not radically different from the amount of wealth destroyed by the housing boom and bust. And yet, as you know, the dot-com bust led only to a mild recession. The 2001 recession went from, I believe, March to November of 2001. It was only an 8-month recession. Unemployment rose, but it was not anything nearly so dramatic as in the 80s or more recently. And so here we had a big boom and bust in an asset price, but without too much real serious or lasting damage to the financial system or the economy. Now, in the recent case, we had a housing boom and bust. If we were looking back at 2001, we would think that, well, that's going to cause a slowdown in the economy, but probably it won't be that serious. And that was one of the views that we were discussing in the Fed in 2006 as we saw house prices decline. Might this be more like the 2001 episode than something different? And yet, of course, as we know, the decline in house prices had a much bigger impact on the financial system and the economy than the decline in stock prices. And I think to understand that, it's important to make the distinction between triggers and vulnerabilities. The decline in house prices and the mortgage losses were a trigger. Use another metaphor, it was a match thrown on kindling. But there would not have been a conflagration unless there was a lot of dry tinder around. And in this case, there were vulnerabilities in the economy and the financial system that the housing bust, in some sense, set afire. In other words, there were weaknesses in the financial system that transformed what might otherwise have been a modest recession into a much more severe crisis. Now, what were those vulnerabilities? What was it about the financial system of the United States and of other countries as well that transformed the housing boom and bust into, again, a much more serious crisis? Again, we'll talk about this in much more detail next week, but just to preview, there were vulnerabilities in both the private sector of our financial system and also in the public sector. On the private sector, many borrowers and lenders took on too much debt, too much leverage. And one reason they might have done that is because of the Great Moderation. There's 20 years of relatively calm economic and financial conditions, and people became more confident, more willing to take on more debt. The problem with taking on too much debt is that if you don't have much margin, if the value of your asset goes down, like the value of your house, then pretty soon you find that you have an asset which is worth less than the amount of money you borrowed. A second problem, a very important problem, was that throughout this period, financial contracts, financial transactions were becoming more and more complex in ways which I'll describe. But the ability of banks and other financial institutions to monitor and measure and manage those risks was not keeping up. That is, their IT systems, their resources they devoted to risk management were insufficient for them to understand fully what risks they were actually taking and how big the risks were. So if you had asked a bank in 2006, well, suppose house prices fall 20%, they probably would have greatly underestimated the impact of that on their balance sheet because they didn't have the capacity to measure accurately or completely the risks that they were facing. The third problem, which I'll come back to again, is the funding side. Financial firms, in a variety of contexts, relied very heavily on short-term funding, like commercial paper, which can have a duration as short as 1 day, or most of it is less than 90 days. So like the banks in the 19th century that were relying on deposits and making loans, they had essentially on the liability side of their balance sheet, they had a very short-term liquid form of liability, which, as we'll see, was subject to runs in the same way that deposits were subject to runs in the 19th century. A final private sector vulnerability was the use of exotic financial instruments, complex derivatives, and so on. An example of this was the credit default swaps employed by the AIG Financial Products company. AIG used the credit default swaps essentially to sell insurance to investors on the complex financial instruments that the investors held. So basically what AIG was promising was that if you lose any money on these collateralized debt obligations or whatever these things are, we'll make good. As long as the economy was doing well and the financial system was doing well, then they were just collecting the premiums on this insurance essentially, and there was no problem. But once things went bad, their being on one side of all these bets meant that they were exposed to enormous losses, which had, as we'll see, very serious consequences. So those are some of the problems that occurred on in the private sector. Let me talk a little bit about the public sector. There were also serious problems there as well. First, the financial regulatory structure had been changed, of course, a number of times. But basically, it was the same structure that had been created in the 1930s after, during the Depression. And in particular, it didn't keep up with all kinds of changes in the structure of the financial system. One aspect of that was that there were many important financial firms that didn't really have any serious comprehensive supervision by any financial regulator. So an example of this was AIG, which was an insurance company. The insurance regulators looked primarily at the insurance products they sold. The Office of Thrift Supervision looked at primarily at the thrift, the small bank that they owned. But nobody was really looking carefully at this CDS problem that I was just describing. Another category of firms that didn't have much oversight were investment banks, like Lehman Brothers and Bear Stearns and Merrill Lynch. There was no statutory oversight of those firms. They had a voluntary agreement with the SEC for oversight, but there really was not comprehensive oversight of those firms. And as I'll talk about, another group of firms was the government-sponsored enterprises, Fannie and Freddie, which did have supervisors, did have regulators, but for reasons I'll explain, was very, very inadequate. So the regulatory structure had lots of holes in it, and there were many important firms that proved important during the crisis that didn't have good oversight. There were also, even where the laws provided for regulation and supervision, it often wasn't done as well as it should have been. And while this was true across a whole range of agencies and parts of the government, since I'm the Fed chairman, let me talk about the Fed. The Fed made mistakes in supervision and regulation. I think two I would point out. One would be in our supervision of banks and bank holding companies, we didn't press hard enough on this issue of measuring your risks. I mentioned before that a lot of banks simply didn't have the capacity to thoroughly understand the risks that they were taking. The supervisor should have pressed them harder to develop that capacity, and if they didn't develop that capacity, should have restricted their ability to take these risky positions. I think the Fed and other bank supervisors didn't press hard enough on this, and that turned out to be obviously a serious problem. Another area where the Fed, I think, performed poorly was in consumer protection. The Fed had some authorities to provide some protections to mortgage borrowers that would have, if used effectively, would have reduced at least some of the bad lending that occurred during the latter part of the housing bubble. But for a variety of reasons, that wasn't done not nearly to the extent it should have been. In 2007, when I became chairman, we did undertake some of these protections, but that was obviously too late to avoid the crisis. So where there were authorities and powers, they weren't always effectively used, and that obviously led to some weaknesses. And then a final, and perhaps more subtle point, the way our regulatory system is set up, individual agencies like the Fed or like the OCC or the Office of Thrift Supervision typically had as their responsibility just a specific set of firms. So the Office of Thrift Supervision was only responsible for thrifts and similar institutions. Unfortunately, the problems that arose during the crisis were much broader based than that. They transcended any single firm or small group of firms. They transcended the whole system. And so essentially what was missing here was attention, enough attention being paid to things that could affect the system as a whole, as opposed to just individual firms. And so nobody was really in charge of looking to see whether there were problems related to the overall financial system or the relationship between different markets and different firms that could create stress or even a crisis. So those were some of the vulnerabilities in the public sector. And we're going to come back to these vulnerabilities and how they played out next week. Let me conclude here by talking about a controversial topic, which is another aspect, which is the role of monetary policy. Now, many people have argued that another contributor to the housing bubble was the fact that the Fed kept interest rates low in the early part of the 2000s following the recession of 2001. So when the economy got very weak and there was very slow job growth in 2001 and subsequently, and when inflation fell very low, the Fed cut interest rates, and in 2003, the federal funds rate got down to 1%. And there are people who argue that this was one of the reasons that house prices went up as much as they did. And in fact, it is true that low interest rates, one of the purposes of low interest rates that the monetary policy achieves is to increase the demand for housing and thereby to strengthen the economy. Now, as I say, this is very controversial, but it's also very important, not only because we want to understand the crisis, but because going forward, we want to think about, what should we take into account when we look at monetary policy? To what extent should we be thinking about things like housing bubbles when we make monetary policy? Now, we've looked at this in great detail inside the Fed, and there's been a lot of research outside the Fed, and let me just warn you that there's no consensus on this, and you'll probably hear different points of view, but the evidence that I've seen and that we've done within the Fed suggests that monetary policy did not play an important role in raising house prices during the upswing. And let me just talk a little bit about some of the evidence on this question. One piece of evidence is the international comparison. People don't appreciate that the United States, the boom and bust in the United States was not unique. Many, many countries around the world had booms and busts in house prices. And those booms and busts were not very closely related to the monetary policies of those particular countries. For example, the United Kingdom had a house price boom that was as big or bigger than that in the United States, but monetary policy was much tighter in the UK than it was in the United States. And so there's a bit of a puzzle for the monetary theory of the house boom. Another example, which is not on the slide, as you know, Germany and Spain both share the euro, so they have the same central bank, the European Central Bank, the same monetary policy. Germany's house prices remained absolutely flat throughout the entire crisis. Spain had an enormous house price increase, considerably larger than that in the United States. So the cross-national evidence raises at least some concerns. The second issue is the size of the bubble. It's true that changes in interest rates and mortgage rates should affect house prices and demand for homes, as I said. And there is a lot of history, a lot of evidence to look at that over a long period of time. But when you look at how much interest rates changed, including mortgage rates, and how much house prices moved, based on historical relationships, you can only explain a very, very small part of the increase in house prices. In other words, the increase in house prices was way too large to be explained by the relatively small change in interest rates associated with monetary policy in the early part of the 2000s. The final piece of evidence I would raise is the timing of the bubble. Robert Shiller, an economist who is well known for his work on bubbles, including the housing bubble, argued that the housing bubble began in 1998, which of course is well before the 2001 recession and before the